Are you interested in investing in the stock market but unsure where to start? You're not alone. Many people dive into buying individual stocks, only to find it challenging to pick winners consistently. When it comes to investing, you have two main choices: individual shares and mutual funds. Buying individual shares means purchasing ownership in a specific company, like Tata or Infosys. It's thrilling but risky. Mutual funds, on the other hand, are pools of money collected from multiple investors, managed by professionals. They invest in various stocks and assets, offering a diversified approach that reduces risk. Mutual funds come with several advantages over individual stocks. First, they offer professional management. Experienced fund managers monitor the market, research companies, and make informed decisions, so you don't have to stress over picking stocks. Second, mutual funds provide easy diversification. Your money is spread across multiple stocks and sectors, reducing risk. Third, they are accessible and flexible, with low minimum investment amounts. You can start with as little as Rs 500 a month through a systematic investment plan, or SIP. Fourth, some mutual funds, like equity-linked savings schemes, offer tax benefits under Section 80C of the Income Tax Act in India. Lastly, mutual funds offer liquidity, allowing you to redeem investments anytime. Let's talk numbers. Mutual funds are known for their stability and moderate returns, with long-term equity mutual funds averaging 10 to 12% annually. This might not sound as exciting as the stock market's highs, but it's a safer bet for steady growth. For example, if you invest Rs 10,000 per month in an equity mutual fund with an average return of 12% per annum, after 20 years, you could grow your wealth to around Rs 1 crore. Stocks, on the other hand, can offer higher returns, but come with higher risk. Certain stocks have delivered returns of 20% or more in a single year, while others might dip and result in losses. Whether you choose mutual funds, stocks, or both, keep these tips in mind. First, set clear financial goals. Ask yourself why you're investing. Is it for retirement, buying a house, or a short-term goal like a vacation? Knowing your goal helps you pick the right investment product. Second, don't chase returns. High past returns don't guarantee future performance. Look for funds or stocks that align with your goals and risk tolerance. Third, diversify to manage risk. For mutual funds, you're already diversified, but mixing a few types can further balance your portfolio. Fourth, start small and gradually increase. With mutual funds, you can start with a SIP of Rs 500 or Rs 1,000. Lastly, stay informed but don't panic. The market fluctuates, and long-term investors benefit from patience and discipline. Consider a real-life example of mutual fund growth. Imagine starting a SIP of Rs 10,000 per month in an equity mutual fund in 2010. Fast forward 10 years, and with an average annual return of 12%, your initial investment of Rs 12 lakh would have grown to around Rs 22 lakh. On the other hand, someone who invested Rs 1 lakh in a high-performing stock like TCS in 2008 might have seen it grow to more than Rs 15 lakh by 2023. However, stocks like Yes Bank lost almost all value over a similar period, highlighting the potential rewards and risks. If you're new to investing, mutual funds offer an excellent entry point into the stock market. With benefits like professional management, diversification, tax savings, and flexibility, they allow you to grow your money steadily without the complexity of picking individual stocks. Plus, they offer lower risk compared to investing directly in shares, which is crucial for beginners looking to build wealth over the long term. So why wait? Take the first step towards your financial future today.